Welcome back to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, April 6th, and markets are doing that thing where one rumor can move your retirement more than your actual contributions.
My retirement is basically powered by vibes and employer matching. So if the rumor mill is in charge, I'd like to speak to the manager of the global economy.
Today, U.S. stock futures up on a reported ceasefire push, oil whipsawing, gold trying to decide if it's a bunker or a trampoline, and Bitcoin popping on headlines. Then we'll use Jamie Dimon's annual letter as a real-world risk checklist you can actually apply.
So the market is basically a golden retriever. Someone says ceasefire, it wags. Someone says escalation, it pees on the rug.
Bloomberg's Markets Wrap said U.S. stock futures rose and crude dipped as investors focused on a report of a push to secure a potential ceasefire in the Iran war. The key idea: markets are pricing probabilities, not certainties, and they reprice fast when the odds shift.
Explain pricing probabilities like I'm deciding whether to buy the expensive eggs or the normal eggs.
It's basically like insurance. If the chance of a bad outcome drops, you pay less for protection, and risky stuff looks more attractive. A ceasefire push lowers the perceived risk of supply disruptions, so oil can dip and stocks can breathe.
But isn't that kind of fragile? Like we're trading on someone might be thinking about peace, and I can't even trade my old couch for store credit.
Yes, and that's why you need a plan. For normal investors, don't chase the first move. If you're long-term, you rebalance, trim what spiked, add to what you already decided you want, and keep cash for bills. Headlines are not a strategy.
I disagree slightly. Sometimes headlines are my entire cardio. I sprint to my app, panic sell, then sprint back to buy it higher. It's called interval training.
Let's talk oil, because this is where geopolitics hits your wallet. Multiple reports describe oil as choppy and elevated. Saudi raising crude premiums for Asia, and broader concern around the Strait of Hormuz. When oil spikes, it's a tax on everything that moves.
It's not just gas is expensive. It's my delivery fee has a delivery fee. Even my salad is like, due to fuel costs, we added a surcharge.
Exactly. Think of oil like the shipping lane of the entire economy. Higher crude can lift transportation costs, then goods prices, then inflation expectations. And if inflation expectations rise, central banks get less comfortable cutting rates, even if growth slows.
So oil is the villain, and the Fed is the strict parent who cancels rate cuts because we all misbehaved at the pump.
That's the analogy, yes. Actionable move for households. Treat a fuel spike like a temporary expense shock. Update your monthly budget, check your emergency fund runway, and if you're carrying high-interest debt, prioritize paying that down, because volatile inflation can keep borrowing costs sticky.
Okay, safe havens. Gold is doing the dramatic fainting couch routine, and Bitcoin is like, I'm also a safe haven, while wearing a party hat.
Bloomberg noted gold steadying as traders weighed diplomatic push headlines, and CoinDesk reported Bitcoin rallying on reports of ceasefire talks. Different reasons can produce the same direction. Gold often moves on fear and real rates. Bitcoin can move on risk sentiment and liquidity expectations.
So gold is the friend who brings a flashlight to a blackout, and Bitcoin is the friend who says, I know a shortcut, then drives into a lake.
Harsh, but not entirely unfair. Practical takeaway: if you want to hedge, size it like a hedge. Don't turn it into your entire personality or your entire portfolio. And remember, a headline-driven rally can reverse fast when the next data point, like inflation, arrives.
Now, to Jamie Dimon's annual letter, this is like when your most responsible friend texts you a list of risks, and you're like, stop, I'm trying to enjoy my denial.
CNBC summarized Dimon citing risks in geopolitics, AI, and private markets. Here's the useful part. Treat it as a personal audit. Geopolitics hits energy and inflation. AI hits jobs and margins. Private markets matter because stress can spill into credit conditions and valuations.
I'm going to push back. AI risk gets thrown around like confetti. Half the time it means my boss wants to buy software and call it a strategy.
Fair disagreement. But for individuals, AI risk isn't abstract. It's, are your skills becoming cheaper? So your action is concrete. Identify one workflow you can automate and one skill you can deepen that's hard to replace. That's career hedging, not hype.
Okay, I'm reversing my stance slightly. If AI is coming for my spreadsheets, I'll simply become the person who knows what the spreadsheet means. That's called management, right?
Wrap up in 3 moves. 1. Don't chase ceasefire headlines. Rebalance instead. 2. If oil stays elevated, tighten your budget and protect cash flow. 3. Keep hedges sized reasonably. Gold, crypto, whatever you use, because volatility cuts both ways.
And if you learned something today, subscribe. If you laughed, also subscribe. If you panic sold, subscribe twice, and then go take a walk.
Drop a comment. What's your plan if oil volatility keeps pushing inflation expectations around? Do you change spending, change investments, or change jobs? See you next episode on BD Daily Finance News Podcast.